In this video, we take a quick look at Microsoft from a shareholder's perspective. Now, as a shareholder, or potential shareholder, the main question that you would want answered about any company is how good are they at using the invested capital to generate earnings and therefore to increase the shareholder wealth. Shareholder wealth can build up in two ways. It can build up as equity inside the company or as dividends that the company has paid out to its shareholders. So let's start by looking at equity. Here's how the equity of Microsoft has been changing for the past 15 or so years. And just to be very, very clear, what we're looking at here is not the market price, but the underlying equity. So the price is what you pay to get a share of stock, but the equity and the dividends and the future growth of equity is what you get. So we're looking here at the underlying value of shares of Microsoft. The value of equity per share, and I've adjusted these numbers for stock splits so that we can compare them across the years, has been growing very, very nicely from 95 till about 2005. In fact, it has increased more than 10 times in that period, which is a return of about 25% per year. That's spectacular. But then in 2005, there was this very noticeable drop in equity per share. It turns out that it has a benign explanation. Around 2005, Microsoft's management decided that the company has grown so large that there was no more productive way for them to use shareholders' equity, and then they returned some of the equity to the shareholders rather than just sitting on it. So if we look at the aggregated dividends that they paid out to their investors, we see that right around the same time, in 2005, there was this massive one-time dividend, and then dividend payments continued ever since and have been increasing. So in fact, if we add up the dividends on top of the equity, we see that certainly no value was destroyed around 2005. It's just that some of the equity was converted into dividends, which is great. Now, one thing about this chart that would worry me a little is that after 2005, we can see this modest decline in equity, but it turns out that it has a pretty similar explanation. Let me slide the chart over and then add a graph of dilution. Now, what we're looking at here is whether the number of shares in Microsoft was increasing or decreasing over the years. And again, all of this is adjusted for stock splits. So from, let me choose a different color here. From 95 till about 2000, Microsoft was diluting its shareholders. There were more shares. Perhaps they were buying companies using shares, or perhaps there were a lot of stock options issued. Then they got the dilution under control, and the number of shares stayed roughly flat. But from 2005 and on, we can see that it has been decreasing. In fact, it has dropped by about 20% by now, which means that Microsoft was buying back shares in the market. And whenever you have share buybacks, I won't go into too many technical details here, but normally the company has to buy back shares in the market at a price that's higher than the book value of equity. So for a while, it looks like the remaining equity is going down, but then once there are fewer shareholders left to split the earnings between them, you will have higher earnings per remaining shareholder, which is kind of what we see on this graph. So just to wrap this up, let's look at the impact that all of this had on the returns on equity that Microsoft's shareholders have been enjoying. And what we find is that up to 2005, the returns have been steadily deteriorating. And in fact, by 2002 and in 2004 and 2005, the ROE was about 10% per year, which is what average large US company produces. And it's really not that great for Microsoft. So thanks to its ballsy decision by its management to return much of the equity to the shareholders, we see that the returns on equity have improved. And in fact, in this 15-year time span, the average return for Microsoft is around 28%, which is pretty spectacular. So the overall conclusion here is that Microsoft has done very well for its shareholders and has made some strong decisions in favor of the shareholders, such as returning some of the equity in the form of a dividend. Not many companies have the balls to do that. But of course, this is only one aspect of analyzing any company. You would want to know a lot more before making an investment decision. For example, the next question could be how much of this equity is due to real tangible assets versus intangibles and goodwill. And we'll look at that in a later video. So thank you for watching. And if you want to get these graphs, or if you want to propose any other companies for me to look at in future videos, drop me an email at sergebert@stockpop.com. That's SERGEBERT @stockpop.com.